Good morning, everybody. It is February 28th, 2026. This is WPF Insiders, the group for women's personal finance. And we are here with our very own member, Peggy James, to do, I think this is the third annual tax planning AMA session. And excited to see some updates and some new tips and things to keep in mind. As a reminder for me and Angela, I'm Regina. Angela will say hi. We are not financial professionals, so anything we say is just informational, educational, but not personal advice for you. All right.
And good morning. And yeah, like Regina said, this is our third time we've had Peggy on. She did such a great job the first year that we asked her back, and then we've asked her back again. And we did have a longer thread in Discord and had a bunch of questions answered there. So if you didn't see that, I think it was under general. And then I think you're also answering some of those questions in this slide deck too.
Yep.
Yep. All right. So welcome, Peggy. Take it away.
All right. Well, thanks so much for having me, and thanks for being here. I know Saturday morning slash early afternoon is maybe not super conducive to having a conversation about fund taxes, but we'll try to make it as interesting as we can. So start off. Whoop, hang on one second. There we go. All right. So sorry, I have to give a few disclaimers as sort of part of the deal of being a CPA. So I am a CPA. I am not your CPA. So what follows in this presentation will be general advice. It may or may not be relevant to your specific situation. So I encourage you to please do your own research, and if you find it necessary, to consult a tax professional. My training and area of expertise are in U.S. taxes. I'm not very familiar with international tax laws and treaties, although I have my first foreign national client this year, so that'll be kind of interesting learning experience. My business is based in the state of North Carolina. That's the state I have the most familiarity with, but I do have clients around the country these days, and so getting more and more familiar with other states as well. All right, just a little bit of bio, a little bit about me. I am a CPA, a certified public accountant, spelled wrong, based in Durham, North Carolina. Started my own firm in 2021. So this is currently my fifth tax season as a solo practitioner. My client base is made up of individuals, small businesses, and I have a few small nonprofits as well. On the tax side, about 75% of my clients have self-employment or business income of some sort. So that includes people who are reporting on a Schedule C of Form 1040 as sole proprietors, or a few S Corp filers as well. All right, before we dive into some of the questions, I wanted to give an overview of some of the tax law changes because this has been kind of a hot topic for a lot of people. I'm referring to it as OB3 because I refuse to use the ridiculous name that they gave the tax law last summer, so we're just going to go with that. So there are a set of changes for 2025, and then there's a few for 2026 that I'll go over. This is definitely not all of the changes, but these are some of the ones that are going to impact the most people, or that I'm sort of hearing the most chatter about. So first off, they did increase the standard deduction slightly over what it was scheduled to be. So standard deduction for 2025, $15,750 if you're filing single, or married filing separately, $31,500 for married filing jointly. You've probably heard a little bit talk about this senior deduction that's new. It is up to $6,000 per taxpayer who's 65 plus. A few things to know about that. There is an income phase out, and you're going to see this on a lot of these items. They added that for whatever reason. But it starts to phase out at 75,000 to 175,000 of modified adjusted gross income if you're single, 150 to 250,000 if you're married filing jointly. And that last one is not a typo. I don't know why they didn't just double everything, but yeah, that is what the range is there. This will be reported and calculated on the new Schedule 1A. That's for what are called below the line deductions. So these do not impact your adjusted gross income, but they do affect your taxable income. And it's just a new schedule that they've added for this and a few other items that we'll talk about. In order to take advantage of this, if you're a married couple, you have to file jointly. You can't be filing separately for that. And this new deduction is available for both itemizers and for non-itemizers. All right, more changes. May have heard about this one as well. SALT is the acronym for state and local taxes. So a few years back, they capped that. This is part of itemized deductions, so it may or may not apply to your situation. But this includes things like state income taxes, real estate property taxes, and in some states, like car taxes, things like that. And they it was sort of to punish the states where, usually blue states, but places where there were, higher income levels, higher property taxes, that kind of thing. So they capped it at $10,000. This legislation bumped that cap up to 40,000, which is kind of nice. There is another income phase out on that though, and so you may or may not be able to qualify for it. But it is something to know. What I'm finding with my clients is that because of that larger standard deduction that they instituted starting in 2018, a lot of folks who maybe had been itemizing, it was no longer beneficial to do that anymore. And so they went to use the standard deduction. I'm seeing more people being able to benefit from itemizing because of this, in large part, this SALT cap increase. So just keep that in mind if you've always done this, or you've been doing the standard deduction the past few years, but are kind of on the cusp, run the numbers and see you might benefit from itemizing given that situation. There's a new auto loan interest deduction. It's up to $10,000. There's some rules around that. It has to be manufactured or assembled in the US, and there's a few other things. That interest is being reported on this is a new form 1098 BLI. Sadly, there were a bunch of energy efficiency tax credits that have been bumped up a few years ago during the Biden administration. This legislation had early expirations, early sunsets on these. So the clean vehicle credit for EVs, that expired September 30th of 2025. And the energy efficiency improvements, these are for things like HVAC. I know I got a wood burning fireplace insert. There are a few items like that. Doors, windows, insulation, those things. Those expire December 31st of 2025. So,
Solar panels too.
yeah, solar panels, big one.
Peggy,
Yeah.
when you say those expired, do you mean like for purchases after that date it doesn't work, or that at that date you can no longer, if you do your taxes after that date, you can't apply for the credit?
Yeah, great question. So if the purchase was made, basically if it was placed in service before or on December 31st of 2025, you qualify for the tax credit. If that was after that, January 1st, 2026 or later, tax credit went bye-bye, sadly.
Yeah, and I know it was installed because it was an issue for like solar panels and stuff that like even if you had pre-purchased them and had a contract to install them, and if they installed them after December, you didn't get the credit.
Yeah. Yeah. And there were a few, like they were trying to get people in. So there were a few situations where they would sort of let you, if you were at a certain point in the process, that was usually for solar, just because that's a much longer sort of installation process. But definitely double check on that. One thing that's new on these, so this is the last year for the tax credits, but if you got in on this deal, there's a new requirement. It's called the Qualified Manufacturer ID. There's a 4-character code that has to go on the tax return, and that is for the the company that manufactured whatever the product is that you're using. So like my wood burning fireplace insert, I had to go back to the manufacturer and get that. They should, I mean, this has been in place for a while, and so they should know about it. Most of them will be on the website of the manufacturer. I did have one. I actually got an exterior door done as well, and boy, I had a devil of a time trying to get it. They kept saying, "Oh, it's not available. It's not available." So anyway, so just know that that's required on the tax return in order to claim the credit. You can't file the tax return without it and get the credit. Last thing on this slide is about the 1099-K. So this is for payment processors. So things like PayPal, Venmo, Square, Stripe. There was a lot of chatter because they had, there's a reporting threshold a while back that required you to have $20,000 that were processed by that processor, as well as 200 transactions. A lot of people did this. I mean, this was really intended for small businesses, but they were going to reduce that threshold significantly to just $600 of payments that ran through. So a lot of people were very concerned, understandably, about like, well, I get, Venmo for, I'm paying part of a restaurant bill or something like that. Like, how are they going to know that that's what it is? And so they have, this is going to revert back to the $20,000 plus 200 transactions. So a lot fewer people are going to get swept up in this, which is good. All right, a few more things for 2025. Probably have heard about some of these. The deduction for tips up to $25,000. So you have to work in a field that it customarily accepts tips. So sadly, as a CPA, I can accept a tip, but I can't use this new deduction. So it's got to be, it's the things that you would think about. It's like restaurants, hairstylists, things like that. But Treasury did put out a list of those occupations if you're really interested. So this is available for both W-2 employees. That tip income is going to be reported on box 7. It's also available for independent contractors. So if you're an independent contractor but worked in a field that normally accepts tips, you can qualify for that too. This is another of those below the line deductions. It's going to be on Schedule 1A. So it's not going to affect your adjusted gross income. It does reduce your taxable income. There's also a deduction for overtime. It's up to $12,500 per taxpayer. A few things to keep in mind on this. It has to be considered qualified. And so I didn't go into a lot of detail on this one, but just be careful about that because it sort of depends on like, are you really like an exempt employee versus non-exempt? If you're exempt, you're not going to qualify. Non-exempt, it's fine. And there are a few other pieces of that. So just be wary of that. If you think you're going to get that and you're wondering about it, I would go check out the IRS website and make sure that you're going to qualify if you're going to try to claim that. It is also only available on the overtime portion of the pay. So when you think of like time and a half as overtime, it's that half portion. So it's not the full amount of overtime pay. It's just the part that's actually related to overtime. This came so late in the year that they were not able to change the W-2 in order to accommodate this. And so it may or may not be on your W-2. Some employers put it in box 14, which is kind of a catch-all. It's literally other is the name of the box. And so it may be itemized there. I've seen that with a few clients. If it's not, you're going to have to do some digging. So you're going to have to pull up your pay stubs and sort of do some calculations and figure out what the overtime is. And then the last thing on this one for 2025, there was an increase in the child tax credit, went from $2,000 to $2,200 per child. All right, so that was 2025, and then a few I wanted to highlight for 2026. Again, this is definitely not all of them, but just a few that are kind of interest. 1099 NEC, so this NEC stands for non-employee compensation. So like I get these as an independent contractor, freelancers, that kind of thing. If you're doing DoorDash, Uber driver, that kind of thing, you're probably going to get one of these. So the reporting threshold has been $600, which means a lot more people are getting these. It's increasing to $2,000 for 2026. So that means if you had $2,000 or more of income that was related to this, you would get the form starting in 2026. If not, you won't. That does not mean the income's not taxable. I feel like it's my responsibility to tell you that. It just means that they're not going to report that to the IRS. There are a few changes to charitable deductions that might be of interest. So if you're itemizing deductions, they've created now for 2026 a 0.5% floor. So that means the first 0.5% not deductible, anything above that is deductible. I'll be very curious to see what this does to charities, honestly, because I feel like it's kind of a penalty for people who are itemizing and giving a lot of money. On the flip side of that, they did add something for non-itemizers. So there will be a $1,000 per taxpayer deduction for non-itemizers. This is only for cash donations. So it doesn't include goods, like if you're donating used clothing, that sort of thing. Donor advised funds, also not part of this, or investments. So if like you're donating stock that's appreciated in value to a charity, sadly, that's not going to qualify for this particular deduction. But I do think more people are going to be able to take advantage of this either way. And that is $1,000 per taxpayer, meaning that if you're a married couple filing jointly, it's $2,000 total for you. I just added this one because I thought it was kind of interesting. This will never affect me or anybody I know, but the estate and gift tax exclusion. So this is the thing that was, especially the wealthy people were yelling about a while back, that like, we're getting taxed when we die, it's a death tax. So there's basically, this means that up to this amount is going to be excluded from taxes. And so they increased it to $15 million. That number will also be indexed to inflation. And that's important just because a lot of things, they just sort of name a number and then it sticks for a long time. But this way it'll be indexed for inflation. Again, I just thought it was interesting. I don't think it's really going to affect a lot of us here.
Side note on that one, Peggy, because we do have a fair amount of people here who are higher net worth and insiders, probably not many, if any, that will be impacted by this particular change. But it would be interesting at some point to probably for a lot of us to learn a little bit more about like the estate and how that works as you're approaching higher levels of net worth. I think that's a blind spot that a lot of us who did not grow up with wealth
Mhm.
have. So maybe we can
Yep.
pin that thought.
Yeah, that's great. Yeah, it's a great point. Yeah, anything like that, feel free. I mean, I'm hoping to do a little bit of kind of writing this summer, so happy to look at some topics that might be of interest to folks and send links to that.
Yeah, great.
Yep. And just one last
Honestly,
note.
on that too, maybe at some point we do a closer to Phi Zoom on that stuff,
Yeah,
Regina, especially if
yeah.
Peggy's got stuff to have us read.
Hmm.
Yeah, not the $15 million, but oh, we might actually have money to pass down to folks.
Two,
Mhm.
$2 million
Yeah.
estate at death kind of a situation. Okay, moving on.
That's right. Yeah, I mean, also on my to-do list for the summer is to finally do my will and all that stuff. So yeah,
You
so
know
that'll
what?
be a minute or two. Yeah.
Maybe we'll put a pin in it in that respect because that is also a number of us have been putting that off for a number of years, and maybe we can have a group accountability session around it.
Yeah, I would love that. Really would. And so this applies to like all the years that these things are going to affect, but a lot of these provisions will be expiring at the end of 2028. That's a very deliberate choice that they made. I'll try to stay out of the political conversation right this minute because I have lots of thoughts and feelings, but just know that they've created all this turmoil and then it's going to end again in a few years. So, all right. So now probably the more interesting part of the presentation. So these are some notes on things that either people ask questions in the Discord thread or things that I'm running into with clients more often, or sometimes a combination of
Okay.
both. And this
Hold
is one
on,
of,
Peggy. We've got a question in the comment on the previous slide.
yeah, okay.
Um, does that mean we don't have to report 1099 income below $2,000?
No, it just means that the person who is paying you is not going to be required to report that to the IRS. So it's still considered taxable. The threshold for self-employment income is $400 that is required reportable by the IRS. So just know that. So sadly, no. But I will just stop there
Okay.
with my own opinions. All right. So I want to talk a little bit about capital gains when you're selling your primary residence. So what I mean by capital gains, for those who may not understand my lingo here, so basically it's profit on the sale. So, this real estate market in particular, I know here in North Carolina, this has been a big deal, that real estate is appreciated in value significantly. And so if that's the case for you, when you go to sell that primary residence, you may be looking at some taxable implications for that. So I want to kind of walk through how that works and sort of things to think about. So there is what's called a capital gains exclusion that's available for folks on the primary residence. And when I say exclusion, that means it's excluded from taxes. So if you're within these thresholds, potentially you wouldn't pay taxes. So there are a couple qualifications for this exclusion. Two tests, the ownership test. So you must have owned the property for 2 out of the 5 years prior to the sale. There's also the use test. So you must have lived in the house, treated as a primary residence for 2 out of 5 years prior to the sale as well. You can
I think
meet,
it's fascinating too that this amount hasn't changed in how long has it been since it's been the 250 to 500?
that's a good question. I want to say like 2008. I mean, like it's been a while.
Yeah.
But yeah, so it's another one of those, when I talked about being indexed to inflation, there's a lot of these things that are not, and it's causing issues like this. Because like, I mean, the real estate market's gone kind of nutty the past few years, right? And so there are a lot of people who are getting caught in this just because they owned a house and held on to it. Like they weren't necessarily thinking, oh yeah, I'm going to make millions of dollars on this, but that's kind of just the way the market went. Yeah. Anyway, so ownership and use test. You can meet each of these tests with two different 2-year periods, but they have to be within the 5 years of the sale date. So got to be kind of tight on the timing. The amount of the exclusion, it's $250,000 if you're single. It's $500,000 if you're married filing jointly. one sort of interesting note to me that I found on this. So I have a client whose husband passed away in 2024, and she was thinking about selling the house that they lived in. She had moved to North Carolina in the meantime from Cape Cod. And there was a timing issue. Like if she sold it within 2 years of the date that he died, then she was eligible for the joint exclusion rather than the single. So there are a few quirks in there, but just if you or a parent maybe is in a situation like that, kind of check on the rules. So I was giving her advice ahead of time because she was thinking about selling me like, hey, I know this isn't the main driver, but like just so you know this is coming down the pike. So anything above that exclusion amount, it will be subject to long-term capital gains rates, which are a preferred rate. So that's a good thing. That rate for most people is going to fall in 15%. So it starts actually at 0 and then 15% and then 20%. That 15% is really the bulk of it in the middle range. The max is that 20%. So just compared to 37% is the max ordinary income tax rate. So decent amount of savings there. Proceeds when you sell a house are generally going to be reported on Form 1099-S. What I'm finding with clients is that this isn't one of those things that you get in January. It's one of the things that's part of the closing documents. So that's where you want to look for it. So if you're having trouble finding it, that's probably where it's going to be. Sometimes they don't issue it. I don't know why that is, but if they don't issue you this form, what I'm advising clients to do is to go ahead and report it anyway, just because you don't know if the IRS has a copy of this form or not. And if they do, all they see is the amount of the gross proceeds. They see like if you sold a house for $1 million, they're going to see that you got $1 million of income. And so you want to be able to prove to them like, no, that's not what it was. And so that you've got the documentation. It's just safer that way. So if you're not sure, I would err on the side of go ahead and report it, do the calculations, show them the math, show them that you qualify for the exclusion. You'll be better off for it, not have to answer questions later.
Peggy, I remember something from a presentation from Mindy Jensen, who does the live-in flip things. And there was also something there about her child or children being co-owners of the home. So they had like 3 or 4 people who owned the home. Am I thinking of the right thing? So they each had like 250,000 of
Yep.
credit there.
Yep. Yep.
Yeah.
And what I would want to do in that situation is talk to the attorney or whoever is potentially going to issue this 1099-S to you and make sure that they know that. Like, I'm not responsible for the whole thing. Like, this child is, and then me, like, I get a fourth of it or whatever it is, just so they can report that. Because I mean, you just want to make sure that you're not going to get socked with the whole thing. Like, I had a client who was recently divorced, and they were able to on the 1099. They each got a separate copy, and it was just 50%, whatever the split was. They
Okay.
each got it reported, so that helped out a lot. And that's one of those things that like you're much better off talking to them ahead of time than trying to sort it out later after they've already done the paperwork. So maybe stating the obvious, but the goal on this is to make the gain as low as legitimately possible. So there's sort of two parts to this. One is to increase the cost basis, which is the starting point, and the other is to decrease the proceeds, which is the ending point. So you've got these 2 points, and you're trying to shrink that gap a little bit, right? Make that as small as you can, legitimately. So on the purchase price side of things, there are a couple of parts of the closing costs that can be added to the cost basis. There aren't many. One of the big ones is the owner title insurance, different from the lender title insurance that sometimes is part of that. But that's one of the main ones. There's not a lot like the property taxes and then maybe HOA dues and things like that you pay at closing. Unfortunately, those are not considered things that can be added to the cost basis. Cost of home improvements do get added to the cost basis. So during the time that you own it, you may be doing some work to the house. Like I added a fence to my property. That fireplace thing I mentioned, like there's a few things like that potentially, and that's a decent amount of money. So make sure that you're tracking those. Like I just have a spreadsheet and I just throw them in there. I just like put the date, put who I paid, what it was for, the amount I paid, just so that when the time comes to sell the house and I've got all that information together. Sometimes people are not clear on like what qualifies. So there are a couple of IRS publications that I could point to if people are interested. They have this list of like, here are the things that are commonly considered improvements to the house. One thing that trips people up a little bit is painting for whatever reason. People get a little confused on that. that's actually considered a maintenance item. It's not considered an improvement. So sadly, if you have your house painted, even though you spent probably a decent amount of money to do that, unfortunately, that's not considered something that you can add to the cost basis as an improvement.
Is
So
there a basic list for things that are considered improvements, like for people who might not be tracking what those expenses are and maybe need a new spreadsheet?
Yep, absolutely. So if you can remind me, I printed out that page from that IRS pub for some of my clients, and I can just like upload that to Discord or put that wherever. I'm happy to pass that along. Yeah, it's a kind of a handy list because I mean, the IRS gets, bad rap for lots of reasonable reasons, but they do provide good information in a lot of cases. And this is one that they've got a list of examples of like, if you did this too, if you got landscaping done, if you did, that kind of thing. So yeah, but happy to pass that along.
And it seems like maybe if you're considering selling a house, that might be the year to have a CPA, even if you normally do your own taxes. It seems like this might be a place where having a professional go through could be helpful.
Yeah. Just because and like, I'm the one who's pointing this out to my clients, like they don't know, right? Like, and I don't expect them to know. This is not their area of expertise. But yeah, so I'm usually the one who's going to my clients and being like, here's this thing that's deductible, like sort of pulling it back from them, just make sure that they get everything qualified. So yeah, that is potentially, it kind of depends on your situation. So if you're selling a house, you didn't do a lot to it, you're like well within the exclusion, probably not worth your money, right? But if you're kind of not sure and want to make sure you take advantage, then yeah, that potentially could be useful. I'm very frugal by nature, so I'm always like, you have to pay for it. Like that's sort of my my balance thing. So I'm not trying to talk you out of doing it, but just to say like, sort of weigh that decision a little bit. All right. Let's see. Selling price. There are a few closing costs that can be subtracted and a few more of these than when you purchase the house. One of the big ones is going to be broker fees. So if you're paying a broker who listed it or sold it or whatever, those will be something that, so you're subtracting that from the gross proceeds to get to your net proceeds number. So again, that top number, we're notching that down a little bit. One caveat that has tripped up some of my clients and a few other folks, if you use your property as a rental or for business use, like you had a home office in it, depreciation that you take during that time is the recapture is what they're talking about. They're taking it back. So it's being taxed at ordinary income tax rates, and that is independent of that capital gains exclusion. So like I have to break the bad news to a client this year that they don't know about, that they're like, oh, we played the rules right. Like we lived in it for this period of time. We use it as a rental, but like we're within the 5-year thing. And so we're within that capital gains exclusion. And so I'm going to have to break the bad news like, yes, and that depreciation, that's not going to be part of that calculation. That's going to get taxed at ordinary income tax rates. So just to know that, I warn people a little bit about that on rental properties as well. The question that sometimes comes up is like, well, maybe I shouldn't take depreciation then because like I don't want to deal with this hassle later, right? Having to pay taxes on it. The IRS says if it was allowable, if you could have taken it, then we're going to treat it as if you did. So you might as well get the benefit on the front end because you're going to have to pay the piper on the back end. So go ahead and take it. Just know that that's coming, that you're going to have to
So
pay
that's a
later.
that's one that is a little more confusing. Like I can say personally, I have a home office, so I'm like taking a basic. I don't know, it's probably like $1,000 or $600. It's not a large, but is that depreciation that I'm taking, or is that
Um,
something else?
No, that's a great question. So there's two methods of doing the home office deduction calculation. So there's the simplified method. It's actually what I use. Sounds like
Yeah.
that's probably what you're using, $5 per square foot.
Hmm.
And so that's just kind of a lump sum, comes off the bottom, but you're not really, I mean, depreciation technically could be part of that, but it's really not considered that. And so you don't have to worry about depreciation in that case. The regular method is you look at the percentage of space that the home office is of the entire property, and then you take all of your housing expenses, mortgage interest, utilities, all that good stuff. And then you say, like, say if it's 10% of the space of the property, it's 10% of the expenses. And depreciation is one of those expenses that's done in that part of the calculation. So you can imagine that like that's probably going to get you a better result potentially if you wanted to do the work and do that. But yeah, this is one of the downsides of using that method. So I tend to walk people through that when they're new to it, just to say like, here are the methods. Yes, you might save a little more money on the front end, but like on the back end, you're going to have to deal with this. So yeah, but in your situation, I think you're safe not to have to worry about depreciation in that
Got it.
case.
So it's kind of if you're using one or the other. So people who are using the simplified version, the IRS isn't going to say you could have been depreciating. It's
Mhm.
got it. Okay.
Yeah. Yeah, because when you fill out the paperwork, they're going to say, there's like a box to check to be like, yes, there
Mhm.
was business use on the property, well, how much was the depreciation, right? And so, yeah, in that case, you would have to know what that is. And then if you're using that simplified method, there isn't any to account for. But yeah, great
Got it.
question. Yeah. And just wanted to put this in here because this also trips people up a little bit. There used to be a rule that in order to exclude gains from taxes, you had to then reinvest the property with or the proceeds within some period of time into another property. This isn't the same as a like-kind exchange, which has a sort of similar rule, but it just was like it was before they came up with this 250, 500 thing. That's no longer the case. So you don't like, I tell people like the taxable event is when you sell it. It's not what you do with the money after the fact. It's just worry about the taxes on the sale. Don't worry about what you do with the money after that as far as taxes go. There are a few questions about dependents in college, and this has also come up with a few of my clients. I want to run through a couple of things. So in this scenario, I've got a dependent who's 18 and is leaving for college later this year. So primary concerns, as you might imagine, am I going to lose the child tax credit? Am I going to lose the head of household filing status? Am I going to lose the ability to claim a dependent, basically? So a little bit of information about how it works for most. This is high level broad, may or may not apply depending on the circumstances, but I think the majority of people, this is how it's going to work. So there is still available a credit for other dependents of $500 if they're over 17, so 18 or older. If they're still in school at least half time and they're less than 24 years of age. So you can still, if you're still supporting them, if they're not kind of emancipated or otherwise just really on their own, then you can still claim them as a dependent and you would be potentially eligible for that credit. There is, you may have heard about some of the tax credits available for tuition. The biggest one is the American Opportunity Tax Credit. So it's up to $2,500 total. So 100% tax credit of the first $2,000 in tuition, then 25% of the next $2,000. Those numbers are very tiny, right? Like tuition's way more than that. So I don't want to downplay that at all. Like that's not going to do a whole lot for you, but it is something. And one thing to explain the difference between a tax credit and a tax deduction. So tax credit, good, very good. It's a dollar for dollar reduction of your tax liability. So if you owed $2,000 in taxes and you got a credit for $2,000, goes down to zero. If you had a deduction, that reduces your taxable income. That taxable income is multiplied by the tax rate. So it's kind of diminishing returns. So if you had that same $2,000 and that was a deduction, that'll reduce your taxable income. If you're in the 22% marginal tax bracket, that's $440 in savings. Big difference, right? So tax credits are more appealing than deductions. Both of them are good, but credits are definitely much more appealing.
And Peggy, someone wanted to know if this applies if someone is going to school outside of the US as well.
That is a great question. I actually don't know the answer to off the top of my head, but we'll be happy to look at it and try to find out for you. If someone can remind me of that, I don't know if you put that in the chat or shoot me a message or whatever. But yeah, happy to look at that. That's a great question. I'm not sure. So one thing to watch out for, I say this because I ran into this with a client last year. If the dependent's income level requires filing their own tax return, make sure that they don't claim themselves as a dependent if you're planning to claim them. It's a pain in the neck. So it's fixable. It's, you can get around, you can deal with it, but it's a pain. So what has to happen is that the dependent has to file an amended return. They have to say like, no, I shouldn't claim myself. Like, here's my deal. And then you can't, unfortunately, e-file a return in this situation on the parent side of it. You have to print it out, sign it, and mail it in. So just to know that it's fixable, but it's just kind of a pain in the neck. So if you've got kids like in this situation, she had helped her son do his return and he was like, no, I didn't claim myself. And he absolutely did. I got a rejection notice when I tried to e-file. So just if you're walking them through like doing a free tax USA or something, just like make sure they're checking the right boxes. It'll save you both a lot of hassle later on. All right. There was this kind of a broad question about like, how do I pay less in taxes? So a lot of this is going to be kind of old news for people. These are pretty common things, but I thought I could run through them a little bit. So if you're a W-2 employee, which is probably the majority of people, there are a few options available to you. There are the old standards, the pre-tax workplace retirement accounts, 401k, 403b, 457, depending on where you work. Some of these may be available. Another one that gets mentioned a lot is an HSA, a health savings account, with a high deductible health plan. Those go in conjunction with each other. If you don't have access to a high deductible health plan, there's an FSA, which is a flexible spending account. And so these can be both for healthcare expenses or for childcare expenses, dependent care. There is such a thing as a special purpose FSA. So that's available for dental or vision expenses usually. The reason that that exists is because generally speaking, you can't have both an FSA and an HSA in the household. As far as healthcare expenses go, dependent care, that's another piece. And so if you do, like if one spouse has an HSA and the other one has an FSA, there's a penalty for doing that. So you gotta like pull the money out of the one or the other and deal with that. Otherwise, you're gonna end up paying some taxes on it. So just to know that, I know that HSAs are super popular in personal finance spaces and for good reason. It's a great vehicle. But just to know that some employers don't have it. Like in the time that I worked at Duke, we never had it. Other employers, we never had it. So it just kind of depends on your situation. So FSAs can be a good thing. One of the big downsides is that it's a use it or lose it situation. So in HSA, you can tuck the money away, save it, it's all good. With an FSA, you say at the beginning of the year, here's how much I want to have set aside in the account. There are some lower limits on that as well compared to an HSA. If you don't use all the money that you set aside, they're pulling it out of your paycheck and putting it in this account. If you don't use it by the end of the year, it goes poof. So just know that. So it can be challenging if you don't have a lot of medical expenses to know like what's the best strategy there. There are a few, like they've extended some grace periods and things where you can have the next few months of the next year in order to use up that money. So that's a possibility. One kind of thing I think is kind of nice to know is that if you have an FSA, so with they're taking the money out of your paycheck and putting it in this account, they actually front load the account at the beginning of the year. So in January, they put the full amount that you've said that you want to set aside for the year into the account. If you leave your job during the year, you have access to the full amount up until the time you leave. So if you're leaving, like say in June, and you would set aside $2,500, if you've got enough expenses, you can go ahead and get reimbursed for all of that. You would have only had in that example 1,250 taken out by then, but you have access to the full 2,500, and they have to pay it out. They can't come after you for it. I've taken advantage of this when I left jobs mid-year, so just know that that's an option. All right, let's see. Last thing on this slide, deductible IRAs. There are income limits on this. So an IRA is an individual retirement account. It's outside of a workplace plan. And there are opportunities to contribute there, but depending on your income level and whether you're covered by a workplace plan, I threw in the numbers on there about what the income limits are. If you try to contribute to deductible IRA and you're outside of these limits, then you're going to end up with a penalty. So it's important to be careful about that. And I just threw in there what the income limit, I'm sorry, not the income limit, the contribution maximum is for 2026, which is $7,500. If you're 50 plus, it's $8,600. So there are a lot of these catch-up contributions for 50 plus. There's also a few if you're between 60 and 63. So just know that right now, the way the tax law is, there's a little bit of a bump up on those catch-up contribution numbers. All right. I wanted to include a little bit of information about folks who are self-employed. It's sort of a soft spot because that's me. So you might want to consider a solo 401k in that scenario. So there are lots of options. The big ones are the solo 401k, a SEP IRA, or a simple IRA. In my opinion, the solo 401k is a pretty good deal if you qualify for it. So the maximum employee contribution for I think it's a 2026 number, $24,500. That is across all 401k accounts. So keep that in mind if, say, you've got a W-2 job and also you're self-employed and have a solo 401k. So you can't, sadly, it's not 49k. You can't double up on that. So you just got to pay attention to what those are for the employee contributions that you're able to do as a deferral. The total contribution limit for a 401k, including the employer portion of the contributions, is $72,000 for 2026.
And is
Um,
that also aggregate across multiple, like if you had two or a W-2 job and self-employed, the max would be 72.
yep, exactly. Yep, good point. So you want to make sure you're being careful about that. So if you've got an employer match, that kind of thing, you want to make sure, like on the W-2, you want to make sure that you're not going to exceed that 72K. So on the solo 401k, the employer match or profit sharing, it's sometimes called, it works out to 20%. This is the max, 20% of net business income or 25% of W-2 income if you're an S corporation shareholder employee. So I've run into this with a few clients, including one last year, who contributed too much because she thought it was based on the 20% of net business income, and didn't realize it was actually limited by her W-2 income from the S corp. So just know that. People probably know already about this, but there is such a thing as a self-employed health insurance deduction. This is actually an above the line deduction, so it reduces your adjusted gross income, which is kind of useful for things like ACA premium tax credits, things like that. So basically, the amount that you're paying out of pocket for health insurance, that's a deduction on your tax return. So that's kind of a nice thing. And just you might include a little bit of information about making sure that you're maximizing legitimate business deductions, just making sure that you're taking care of everything. So I have a few clients who are maybe new to being self-employed and just don't know. And so, it can be helpful to do a little research on that and make sure if you're not sure what qualifies, a good place to start is Schedule C. That's where if you're a sole proprietor, that's where you're going to be reporting your business income and expenses. And the IRS has little categories there like advertising and little things. And so that can be a good way to kind of, um, think about what might be deductible. I just want to throw this out there. One thing that I run into with a lot of my self-employed clients who accept credit card payments, they forget about the credit card processing fees sometimes, because when a lot of times when the money shows up in your bank account, it's the net amount, right? Like they may throw in the gross, but then they'll pull out the processing fees that they charge 3 or 4%. And so when at the end of the year, all they're like, oh, well, here's how much money I got. But I'm asking for the 1099Ks and the 1099 NECs. Those are the gross amount that's being reported to the IRS on those forms. So you want to make darn sure that if you got charged processing fees, that you go back to the Square or the Stripe or the Venmo, whoever it is, and pull a report that shows what those fees are, because that's a business deduction, and you want to make sure that you're taxed on the net, not the gross. All right. Someone asked this really fantastic question about I don't really know much about taxes and people talk about it all the time. Like, how do I learn? Like, how do I figure out what all this stuff is? So just a few thoughts on that. One is to prepare your returns yourself. And what I mean by that is not necessarily get the forms and your pencil and fill them out, but using a free tax USA or software like that, in my mind, that counts because you're getting some assistance with it, but you're having to do it yourself as opposed to paying somebody else to do it for you. If you're going that route, I would say print out the return before you file it, whether that means print to a PDF so you look it on your computer or actually with paper. I would say go through it line by line, the stuff that you have numbers on, and make sure you understand what those are. If you don't understand what those are, that's totally fine. That's very reasonable if you're new to this. The IRS website is actually fairly helpful with this. And so I would just, if you're like, I don't know, what is this adjusted gross income? What is that? Search on the IRS website for that term, and it will give you a lot of good information about what that means and how it's calculated and what it impacts in particular. If you're like me and you're kind of a geek on this stuff, library books are amazing. So I actually did this when I was kind of early in my career before I became a CPA, just because I really like numbers. One resource in particular, J.K. Lasser, annually they publish this thing called Your Income Tax Guide. They update it every year. And it's a lot of, it's just really thick, thick thing. But it is kind of useful if you really want to dig into it and read. If you're just not really all that interested, don't do it. But if you do have some questions or are curious, that's a good resource for you. And library, absolutely, versus buying the book. And I would say finally, use resources like the WPF Discord group. That is a safe space to ask all kinds of questions about money. And if you don't feel comfortable, I hope you do. That's the place to ask the questions. There are no dumb questions. There's no oh, I should know this already. These are the people who have been through it in various forms, and I know stuff about taxes because that's what I do for a living, but there's a lot of stuff I don't know about. And so I'm grateful to have resources like that. So like ask away if you got questions like that. All right. I want to talk a little bit about Roth conversions. This has been a hot topic, both with clients and I see this a lot. I'm in a couple of other like Facebook groups and other groups with personal finance, particularly around retirement and taxes, and just wanted to talk about this a little bit. What I mean by Roth conversion is people who have money in a pre-tax retirement account and want to get it into a Roth. And the advantage of the Roth, you may or may not know, it's tax-free growth and tax-free distributions. So it's taxed on the front end. So you're putting taxable income in or already taxed income in, but then when you go to pull it out, if you meet the qualifications, then the money that you're pulling out is not subject to income taxes, which is kind of nice. Often I see this scenario come up, this question about should I convert? It's somebody who's got retirement savings that are predominantly in pre-tax accounts, and they're like, hey, I kind of think I might be interested in, saving some money on taxes on these things. A few things to consider on this. I put in there maximizing tax brackets, and what I mean by that is so we have this progressive tax system where it's these literally these brackets. So it's like certain dollar amount of income is taxed at X rate, and then it just kind of climbs up. So the income as your income grows, the tax rate grows. One thing to know about tax brackets that trips up a few folks is that may hear people say like, "Oh, I got this raise at work, and now I'm in the X tax bracket, and I'm paying more taxes." Like, well, yes, you're paying more taxes on the income that exceeds the previous bracket. So if you tipped over into a new bracket by $2,000, $2,000 is subject to that higher tax rate, not the whole thing. So it's not your entire income, not your entire paycheck that's being taxed at that level. It's just that little bit that tipped you over into the next tax bracket. So just keep that in mind. But with a conversion like this, if you've got some wiggle room, if you're like, solidly in one tax bracket, and you've got some room, you've got, a few $10,000 before you hit that max, it could be potentially worthwhile to go ahead and do the conversion. It's considered taxable income in the year that you convert it to the Roth account out of the pre-taxed IRA. Another thing that I'm running into more frequently with clients, this applies if you're older. So there's this thing called IRMA, which I prefer to call IRMA because it's easier to remember than the acronym that it stands for. So it is the Income Related Monthly Adjustment Amount. And this is specifically for Medicare premiums. So the amount you pay for Medicare, your monthly premiums, it's based on your income level. So there's kind of a standard rate. And then if your income exceeds a certain level, then it's a certain multiplier of that. There's like a 1.7 and a 2.4. So basically your premium gets more expensive the higher your income goes up to certain limits. There are also kind of brackets on those too. Sadly, it's not quite as nice as the tax brackets in that if you get flipped into the next highest tax bracket, then you qualify for the higher higher rate. There's no like wiggle room on that. So there's a 2-year look back on this. So that means that when they're determining the rates for 2026, they're looking at your income from 2024. So if you're nearing that standard retirement age of 65 or that age when you would start thinking about Medicare, be sort of mindful about what impact some of these moves might have on your Medicare premiums. So I did a kind of a fun project for a client that was like wanted to maximize the Roth conversion, but was also 65. And so wanted to make sure that they weren't going to knock themselves into a super expensive Medicare premium. So there's a little bit of math you got to do to figure that out, but it is kind of an interesting exercise. The good news about this is that this is done on an annual basis. So it's not one of those situations where if you had a lot of income in one year, like, oh, well, you're like an SOL for the rest of your life. It's not that. It's just the next year they'll do they'll reevaluate. They'll see what your income was 2 years prior and move forward with that. Last thing I wanted to say, and this is just me on my soapbox a little bit, is to kind of be wary of FOMO if you're missing out. So one of the sort of criteria for like, does a Roth make more sense or does a pre-tax account make more sense is your tax rate going to be higher in retirement? Impossible to know, really. You can make some kind of educated guesses, I think. But just to think about, like, I think there's an assumption that you're making with all that information And so a lot of people, when I hear this chatter in the groups, it's like, well, I just know I got to do a Roth conversion. Like I got to have all my money in a Roth. And I would just say like, maybe like it could be a good move for you, or maybe it's not. It really depends on your situation and kind of your comfort level. And like, are you caring for elderly? Like there's all kinds of things to be thinking about there. So my last point is just taxes are not necessarily the boogeyman to be afraid of. So like, yes, we want to reduce our taxes as much as legitimately possible. And also we're going to have to pay some taxes. Like that's just the deal, right? So like, don't get, if I can just encourage you, don't get too crazy focused on like, I've got to reduce my taxes and I got to pay as little as possible. Like, yes, and like try to, try to be kind of reasonable about it and try to calm down a little bit, right? Like I had to do this to myself too. Like I get kind of tripped on my own head. So like, just think about it a little bit. This could be a good move for you. Maybe not. That's okay. And that is okay. If none of these are good for you, that's totally fine. You don't have to do them. It's fine.
I have a little, hopefully quick anecdote there, real quick about the Roth conversions. I recently did some projections in Projection Lab, which many of us here are familiar with. But if anybody happens to be watching, the video is like big financial modeling software, and they're like 2 years out from retirement and or from being 65 and retiring, and we're trying to figure out if they're going to do a massive Roth conversion, because pretty much everything that they have is in a 401k, and they also have some pensions, so they have kind of a baseline level of income anyway. And they were pretty confident that they wanted to just do it all right away, handle the tax implications that year, and then let it grow. But it was interesting when we started doing the modeling, that we were able to kind of figure out that if they did it when they were like 84-ish, there was like a break-even point. And this is somebody who's pretty healthy, who has big plans for their first 10 years of retirement, wants to travel a lot, wants to do a lot of things. And and if they live well into their 80s, is likely to die with more money than they know what to do with anyway. So an interesting conversation around that, about like, you can do a Roth conversion later, but if you do it right away, you're going to reduce the amount of money that you have access to in the years when you really want to use it. Maybe you should just continue to reevaluate it and look at it later. But there's definitely, like, especially in the fire space, I think a fixation around Roths, which makes sense if you're able to do that when you're 30 or 40, but doesn't necessarily make the same sense if you're having these conversations much closer to a traditional retirement age. So yeah, I that's what I kept saying. Yes, you will probably pay more taxes overall, but if you're still dying with significant amounts of money, does it really matter? Like, maybe just let's focus on having good years. Yeah, do some math, look at the bigger picture, not just the always minimize taxes as much as possible. They can be okay to pay sometimes.
Yeah, that's a great point. And that reminds me of one thing that I'm running into more often too, which is inherited IRAs. And so that just occurred to me as you're talking about like somebody's at 84, if they're planning to leave it to their kids and that kind of thing. So with inherited IRAs, there's some newer legislation over the past decade or so. You have to, if you're not a spouse and getting an IRA, like say your aunt passes away and you get the IRA, you have to draw that down over, I think it's a 5-year period. So, I mean, there, you find a limited amount of time, and that's taxable income if it's out of pre-tax account. If it's a Roth, it's not, but you still have to do it if it's a Roth too. So that's not going to help you necessarily in this particular scenario. But yeah, so I mean, you don't have you don't get the benefit as a beneficiary who's not a spouse. So just know that too. And also know that you've got to take those they're called RMDs, required minimum distributions, that also happen when you're at retirement age. But yeah, so that is a thing that people are running into more and more often, since those changes.
Because more people have IRAs instead of things like pensions, right?
Mhm.
Yeah. So maybe this is a morbid way for me to wrap up my thoughts before we open questions. But if you have somebody very close to you who has a large pre-tax retirement account, and they look like they're in very bad health, it might be a conversation on asking them if they should just do a full Roth conversion, if they think they might be passing soon, if
Yeah.
family tax estate planning is something they talk about openly. Yeah.
Yeah. And one thing to throw into there when we're talking about RMDs and Roths. So one of the advantages, another advantage of a Roth is doesn't require these required minimum distribution, these RMDs. If it's a pre-tax account, it does when you get to 73 is the cutoff now. So when you get to the age of 73, you have to, the required minimum distributions means you have to start drawing out of the account if it's a pre-tax IRA. That's just, they make the rules, we don't. So you got to start taking it out. So that is one of the nice things about a Roth is that you're not required to do that if it's a Roth account. All right. So I wanted to, I'll probably talk a long time. But if people have questions that I could answer, I'm happy to hang out for a little bit and do that.
This might be a good spot maybe for us to wrap up the official part and let us go off screen. So if people have some, or not off screen, but off recording. So I think we'll do that. Thank you again, Peggy. That was super informational, and we're gonna process all that and start to integrate it just when maybe it goes away, maybe. So, yeah. And hopefully that puts everybody in a little bit better position. We're in February, so you got a month and a half-ish if you do your taxes at the normal tax time to grab any extra documents or look up some things and learn about it or talk to your CPA before taxes are due. And yeah, appreciate you coming and doing this for us again.